All right. Good morning, everybody. Welcome to the December Equi Investor Forum. We're very excited to share a lot with you today. We're going to get started with some brief introductions, talk a little bit about what's been going on in markets, and then we're going to talk about the portfolio, how it's performed, but also more importantly, the outlook looking forward. We'll give you some updates on the company, and then we're leaving a lot of time for Q&A. So thank you also to all of you who submitted questions in advance. We're going to make sure that we address all of those, both throughout the presentation and at the end in Q&A. Along the way, if you have questions, enter them in the Q&A feature that's at the bottom of your screen in Zoom. And it says chat is not activated, so we might have to activate that. And we'll let's get started. So first things first, with you today, you've got a lot of folks from the Equi team. Today, you'll hear from myself, Itay, Jason, Director of Due Diligence on our asset management team. Also, some familiar faces for many of you. Annie and Vince, our wonderful advisors, are here as well. As you have questions, go ahead and end them in the Q&A and we'll address them at the end. We did just activate the chat, so you can also put things there. Now, want to start things off with a quick note of congratulations, as well as a farewell. For those of you who don't know, Jeremy welcomed a new member of the family not too long ago. So Jeremy, why don't you share a little bit?
Yeah, so I've gotten to get to know a number of you over the time here. And I just had my firstborn, which is an amazing milestone for my family, and just kind of understanding how much goes into running the startup life. I just needed a little bit of a different kind of change of speed. So for that reason, I'm going to be leaving Equi in a day-to-day capacity. I'll be staying on as an advisor. But one of the important things is I am the single largest LP on Equi. I have been since we started it. I'm invested in 3 funds. So I think I'm invested in more funds than anybody here. And I have zero intention to pull any money out of my allocations at Equi. In fact, this has probably been one of the most challenging investing environments that we've come across in the past 20 or 30 years. And this is the reason that I feel very comfortable at nights, is because I've gotten something that's really held up well with low volatility. So I've never felt more bullish on the product. The team and the asset management team, which we're going to meet, continues to get stronger. The products continue to get better. So I am 100% a believer. I'll still be a major supporter. I'm here. I'll be paying as close attention to this call as all of you, as I, am a very large LP. And that's really what I want to say. And if there's obviously any other questions, I'm always happy to make time. Big believer in this team.
Thanks, Jeremy. I also just want to speak on behalf of the entire team and thank you for everything you've done over the past year and a half. It has been a wild, wild ride, to say the least. Thank you again and congratulations. So one last time, maybe I want to hand it to you to also ask our signature trivia question.
All right, great. Well, if any of you have joined, we like to do this to get everybody warmed up a little bit. So you're going to have to write into the chat what your answer is, and then we're going to give a few seconds for everybody to answer this out. Oh, it's actually a poll. Okay, thank you so much. All right, so how many lost decades, this would be time between new highs in the market, have there been in the last 55 years? Again, how many lost decades have there been in the last 55 years? So we're going to give it 20 seconds. We'll cue that Jeopardy music. Itay. And when you tell us that we're done, Tory, then we'll go and reveal it. Okay.
Well, the answers are still coming in. They're still coming in. We're still waiting on like 4 or 5 more people. If you haven't clicked, click. This is your last chance.
This is in the United States. This would be, what are we doing? The Dow or the S&P? Itay.
We're measuring with the Dow.
It's the Dow because we have the longest history.
Oh,
go ahead. Great reveal.
Okay, let's do the reveal.
That's so 4 out of everybody here. So a number of people got it. But yeah, it is actually, Itay, why don't you share a little bit about this chart and what we're seeing here?
Yeah, so first off, it's important to realize this is a log chart. A lot of times what you would see is this normal chart that just looks like it's going to the moon and you don't really see the swings. But a log chart looks at all the different peaks and troughs in the same type of way. So a move between 4 and 5 is going to be measured the same way as it is between 5 and 6. So you can really see the magnitude of some of these bear markets. And that's really one of the most important parts in understanding financial market returns, because there's a very long-term trend of that 7 or 8%. But sometimes when you get decades that really exceed that trend, a lot of times you get the following decade that kind of has to revert back to the mean. And that's been a common theme in financial markets. One of the reasons we started Equi was we literally were thinking that we may experience a lost decade again soon. And it was really important for us to have a product that continues to compound returns during some of these periods that are really very typical, right? So it's nothing new, it's nothing crazy. We just forgot about it because we've been in a bull market since 2009, well, with the exception of 2022, of course. So it's a very important thing, and it's really key to our methodology.
Awesome. Well, with that in mind, let's transition the conversation. Let's have a brief look back at what's played out this year in 23, and then a little bit more about what we're anticipating, what you're keeping eyes on for 2023. So first things first, let's look at the top 3 factors that you and the asset management team felt had an outsized impact on 2022. Obviously, many of these things were in the headlines, but here at Equi, we like to go a little bit deeper. So on the next slide, we'll start with inflation. Obviously, you can't log on anywhere without seeing a headline about inflation. What really played out this year, Itay?
Yeah, so to understand that, you really have to go back to 2020 and 2021, which was a great concern of ours. If you were watching the market calls in 2021, we were talking about inflation before it was cool. So really, the global response to COVID was unprecedented. There was a 40% increase in M2 money supply, which again, 40% increase, 40 cents on every dollar. And really, it was the first time that we didn't just see a monetary policy response, there was also a fiscal policy response. So the government started sending stimulus checks and other things that really increased the savings rate. And at the same time, the economy was closed. So people didn't have the ability to spend it, right? So when the economy reopened, all this money started chasing for goods, and really creating the most inflation we've seen since the 1980s. So,
well, let's see what that wall of money actually looks like. If we go to the next slide, you're going to see that is what we call a wall of money.
Yeah. So the quantitative easing type of world starts in 2008. We'll cover interest rate in a second, but we went to the zero bound in 2008. And then, when you get to the zero bound and it doesn't work, you have to go into more extreme measures in order to stimulate the economy. And that was the QE programs. So we started the QE programs. Every time they've been slowed down, we've seen some kind of financial crisis. When QE1 was halted, we had the 2010 flash crash. That was almost a 20% S&P decline. QE2 was halted. We got the European debt crisis. QE3 was halted. We had 2018, which, if you remember, was about a 20% decline. And then COVID happens, and they go just totally crazy. So everything that has happened since the global financial crisis happens all in just 1 year. And that had major...
It's very clear when you actually overlay the NASDAQ on the Fed balance sheet, you can really see a relationship between the two.
That's right. So when you look at what happened, especially after 2020, is that the Fed injected so much liquidity into the economy and into the markets that it just made risk assets explode. And it was all risk assets. It was crypto, it was stocks, and there was so much money going around that people were starting to put money in even more fringe things. And you could argue that 2021 saw speculative bubbles form across many asset classes.
Yeah. So, well, in a response, we got so used to easy money, policy rates bouncing along that zero line. It's wild to look. This chart goes all the way back into the 1970s, and we've been enjoying these low rates for a while. So now, as we're coming off that floor, do you feel that that's the main thing driving everything going on right now?
Yeah. So back to, we got concerned when the Fed said in November, I believe, Powell said in his testimony, I think it's time to retire the word transitory from the dictionary. So they started acknowledging that they've made a fairly large mistake letting easy money run for far too long post-COVID. And it seems like they're almost overcorrecting that now on the other side. We are seeing the fastest increase in interest rates since the early 1980s, when Paul Volcker famously took the Fed funds rate to the double digits. We obviously don't expect that to happen now, but at the same time, from the relative zero base we came on, we're also experiencing quantitative tightening. So the Fed is destroying $100 billion a month in liquidity, which is crazy, right? It's creating a very, very challenging environment, and I think it will continue to create economic volatility.
So let's transition from looking back to looking forward. And it's worth calling out, for those of you who joined our market calls in 2021, Itay was very prescient in all of the factors he identified then to watch in 2022, and managed to call quite accurately a lot of the events that took place. So I think it's worth paying attention to the factors that you're watching in 2023. And so we'll briefly cover those now. We're not going to have enough time on this call to go in depth, but our upcoming market call is going to go much further in depth into these factors to watch in the upcoming year and how they might impact us. So why don't you briefly cover these factors and how they're connected and why they're important?
Yeah. So starting with inflation, that's still the common theme here. Does inflation cool down in 2023? We expect it does. But the question is, to what degree? Up until now, every time we've gone through a soft period in markets or the economy, the Fed was very easily able to intervene and restart QE or lower rates because inflation was never a problem. But the Fed has their hands tied right now to a degree. If inflation still runs at 4% next year, they're going to have a very hard time easing, even if we fall into a recession. And that's what makes this time a little bit different than the prior instances when we got back to easy money. And the question also is, does the Fed even go back to QE, or they think it was not the right policy to begin with, which I've heard some opinions of that. So inflation will determine whether or not the Fed pivots. The Fed pivot, how does it look like? Is it just slowing down interest rate increases or stopping them? Is it actually cutting? Is it going back to QE? All these things are going to have very, very important implications for financial markets. Unemployment is still very low and has been very strong. So whether or not the unemployment situation deteriorates significantly also has a lot to do with the Fed pivot and liquidity. One of the things to understand is that monetary policy works in a lag, right? It doesn't work right away. It takes time for these effects to be felt. Corporate refinancing is a very strong one. There's $6.7 trillion or so of bonds that are going to mature next year, held by corporations, that are now going to have to roll it from very low interest rate to very high ones, increasing their cost of carry, which could lead to layoffs. And that leads us to the next factor, which is housing. Housing market is frozen right now because buyers can't afford it because rates are just too high. They're at 7%. And sellers don't want to take prices down, and they don't have to, right? For example, I'm in a mortgage at 2.75%. What incentive do I have to move and move into a 7% home, right? Zero. But if unemployment...
Getting a mortgage in the past 2 years is the ultimate humble brag right now.
Yeah, exactly. But imagine if unemployment starts ticking up, then you're going to have what's called motivated sellers coming up, and that could change the picture completely. And that's a big risk to the economy. And of course, we have the global environment. We still have the ongoing war in Ukraine. We have an energy crisis in Europe, and this winter is going to be a big test of that. We have other issues in Japan and China that I won't go into, but it's a very complex global environment into 23.
So that leads to, what now? And what are the scenarios that you anticipate for next year? It seems like your view within the asset management team is that it's most likely recession is going to occur at this point. That's base case. Really, the question to be asking is, how severe will that recession be? So, could you give us a little sense of these three scenarios, as well as, the impact on, either the economy and folks' portfolios, since that's obviously what a lot of people are thinking about?
Yeah, so without going into too much detail, our base case right now is that we do go through a mid-level recession, hard landing. So This would mean that unemployment will rise. The Fed will pivot. We don't know the degree of the pivot yet. We believe that earnings will deteriorate substantially. Long-term interest rate may peak because of this recession and expectation of rates falling, but we're also going to see inflation getting tamed because of the recession. So it will be a mid-level recession. There will be some damage, some jobs lost, but we don't expect it to be as severe as 2008. We don't expect wide range contagion. We don't expect this type of bank failure, banking crisis that really takes it to the next level, because we do think that the banking system is more solvent. We don't have the same level of bad loans in the system, particularly in housing, which is a huge sector. Equity in homes tend to be a lot higher. So we do expect this mid-level recession, but not necessarily worse than that. Implications is risk assets will still suffer. It will be difficult for them to reinflate. However, bonds may do well, and alternative strategies may do well as well.
And so this is in order of probability. So hard landing, you think is most probable, soft landing, and then you already kind of mentioned catastrophic as less or the least likely amongst the three. What would a soft landing look like, just very briefly, and then we're going to move into speaking.
Yeah, so the soft landing scenario means that we're narrowly able to avoid a recession, and we just go through slow growth, potentially even the return of Goldilocks. Inflation collapses very quickly, so the Fed is able to ease, and liquidity conditions improve. Unemployment remains low, and we're narrowly able to avoid kind of the worst, the bad scenario, and things do well. Risk assets should do very well under this scenario. And then, of course, the third scenario is everything we said under number one, but we do get contagion. Imagine FTX, but in the real world, somewhere on Wall Street, that's happening and nobody really knows about. We have this massive leverage unwind, and we do go into a banking crisis. So that would be the catastrophic scenario. That's 2008 plus.
So good transition to talk about the portfolio, because although that sounds like a lot of doom and gloom, the reason why you guys are on the call right now is because you, like Itay and I, are customers, and we position the portfolio for these various scenarios, and we'll speak towards how it's positioned to handle these various scenarios. But before we do that, I'm going to hand it to Itay to talk about the asset management team and how that's evolved, and then we'll take it from there.
Thank you. Yeah, so the asset management team really grew this year, starting from a team of one, which was me, into a very diversified asset management team with a very unique and complementary skill set. So starting with Jason, he comes to us from a family office, private family office background with a lot of experience due diligencing different managers as well as strategies, and he brings a lot of these expertise in-house, and he really helps us with the investment committee as well as our process for bringing managers to the platform. We have Noor de Vos, who is a trader. He previously managed over $1 billion at a very large Swiss hedge fund. Prior to that, he worked at different Wall Street firms in exotics and derivative desks. He really helps us with our hedging programs as well as the internal strategies that we run, and some of the things we're building. And then we have Eric Schramm, formerly analyst at US Bank. He's really a brilliant person for building different models. A lot of these type of scenario analysis that we're talking about today is really comes from all these models that he's been building. So very great asset management team, and I'm humbled to be a part of it. So with that said, I'll bring it on to Jason, that he can talk to you a little bit about the performance of the portfolio this year.
Yeah, thanks, Itay, and to everyone on the call here. Great to meet you. If I haven't already spoken to you, really appreciate you, investing with us and trusting us with your capital. We're maybe now getting to the part that everyone really cares about, which is how is your investment performing? And we're excited to report that our portfolios are performing as designed. That is to say, we've been able to avoid large losses in what's been a very difficult environment, while still being positioned to capitalize on upside. And we'll talk a little bit more about what we mean in a few slides on this upside potential. As Itay just spoke to, we're currently going through probably the most challenging macro environment since 2008. We've seen both the equity and the bond markets go down significantly this year. There's been very few places for investors to hide across asset classes. So really a very difficult environment for investors, both individual and professional investors, quite frankly. And despite this, as you can see in the chart, we've really been able to outperform significantly, especially since we launched our internal hedging strategy in February. And I believe we're actually positive since February, since implementing that hedging portfolio, despite the fact that the markets have obviously continued to go down since then. And the last thing I wanted to emphasize on this slide is that we haven't done this by being overly defensive or taking most of the portfolio to cash. We've provided this outperformance, this protection to capital, while remaining fully invested. And by that, I mean that we're still fully positioned for upside capture when that comes. And in the meantime, we're able to protect the capital, avoid big losses, and not try to guess at when to redeploy. We're already positioned to capture that upside to benefit from our strategies when they start providing these outsized returns again. And to give you a little bit more detail about how we've been able to do that, I will turn it back to Itay to talk about some of our top performers this year.
Thank you, Jason. So yeah, I mean, it's really been a mix of some of these slow and steady strategies that are expected to deliver the same return every year. They've performed fairly well. And also the top performer has been our own hedging strategy, in which we're able to negate some of the losses suffered by some of the managers that tend to be more volatile. On top of that, YA has been a very good performer this year as well, and it's been a large position as well as a separate opportunity that can be purchased. And then Equi Tactical, that replaced the hedged S&P in May, has done exceptionally well as well, and even better into December. I know this is as of October, but it's up almost 19 or 20% since it got incepted in May. Jason, do you want to talk a little bit about the laggers?
Yep, happy to. And so everyone can see here in both the growth and the growth in income fund, our volatility ARB has been our bottom performing strategy here. Your first question to us might be, why, if it's performing like that, is it still in the portfolio? What I would say is that part of our job is not just identifying, a strategy that might do well for 1 month, 2 months, 6 months, but building a portfolio that's meant to do well over long periods of time. As part of that, we recognize that some of our strategies will have periods of difficult performance. And this is really where, having our hedge book is an extreme advantage for our strategy, because Itay and the rest of our asset management team have been able to hedge out a lot of the exposure of our volatility strategy. We recognize that this might be a market it struggles in. So we don't have to go, take all our money out of the volatility strategy where we don't then benefit when it rebounds. We can stay invested in it, hedge out some of that exposure to protect the portfolio in the short term. And then the longer term, when it returns to a more favorable environment for this strategy, we're already invested, we're able to benefit it. And just to give people a sense of what I mean by upside, this volatility strategy is one that has had 50, 70, even 100% plus years in the past. And that's in both up and down markets. So it's really one that provides a lot of upside potential, which is why it's really key that our hedging allows us to remain invested here. The other thing I just wanted to point out as you're looking at this slide, this isn't the absolute return of each of these strategies. This is actually its contribution to our portfolio's overall returns, which is essentially a function of that strategy's return and its size in our portfolio. So as Itay was saying about the tactical strategy, for example, we're actually up, this is through October, we were up maybe somewhere in the mid-teens, 15, 17% since May. The 0.86 or 0.86 in both funds that you see here is a function of its size in our portfolio times that performance. Itay touched briefly on the hedged S&P strategy. That is one we exited earlier this year. We'll actually talk a little bit more on the next slide about why we made that decision. And then Itay, maybe you can touch quickly on the fixed income arbitrage strategy, why we're excited about that one over the next year.
Yeah, so this strategy trades credit spreads in different European bonds. And the way it works is that there's a specific carry that's already embedded into that strategy once that credit spread widens out. So because the spreads are now as wide as they were in 2008, the expected downside potential if they continue to widen is very low, because it's going to be very difficult for them to widen even further, even under a catastrophic scenario. And assuming that you have no return of spread to normal at all, the carry that's built in is already 20% for the next 12 months. And assuming that you do get a return to normal credit spreads, if you do have a type of a soft landing or risk on type of environment, it's about a 40% expected return for next year. So being able to keep some of these managers with our hedge book, knowing that there's so much locked in upside potential is really, I think, a unique advantage.
Great. And then, here we're going to walk through the portfolio a bit about some of the new strategies we've added, as well as some of the strategies that we've exited this year. Itai has already really touched on the Equi tactical and the Equi hedging. I would just reemphasize here, we added tactical as an internal strategy. That decision was a combination of deciding to exit our hedged S&P manager, which Itai will talk about next, as well as the expansion of the asset management team, and really the addition of Noor earlier this year, our portfolio manager, who can support a lot of our internal trading and internal strategies. On the hedging side, we've talked about this before. We started this in February. It's been a big help to the portfolio in a difficult market environment, and it's a key component of us being able to remain fully invested and feel confident in being able to not just protect capital, but even provide positive returns. And then the last new strategy that we haven't talked about before is our new options absolute return strategy. This is a strategy really that falls into our slow and steady bucket, but what's probably most interesting about it relative to most of the other strategies in that bucket is that it's not a credit-based strategy. It's in a very simplified way. It's a manager who's seeking to sell options that are well out of the money, meaning that these are options whose strike price or execution price is far away from the current price of the S&P 500. That makes it less likely that the options ever get exercised, meaning that the buyer of the option is unlikely to ever be able to actually use the option they buy. For this manager, that means that by selling the option, they're able to collect premium. They receive a payment for selling the option. If they're right that these options never really end up in the money, their buyer never executes them, then they just expire worthless. The manager gets to keep the premium they collected. And that's why it results in a pretty steady 8 to 12% return year after year, almost regardless of what's going on in the markets. And so this is the type of strategy we really like to find for that slow and steady part of our portfolio, because it can kind of chug along in down years and up years, gives us the confidence that a core part of our portfolio won't have a lot of volatility, allows us to layer in some of these strategies with more upside, but also some more downside volatility to build to an overall return target that we present to all of you. Itai, I'll turn it over to you again to talk about our decision to exit crypto as well as our hedged S&P manager.
Yeah, thanks, Jason. And just to add to that, option selling strategies can be risky in the event they go in the money. However, this manager, unlike many other strategies we found that are similar, has a very good strategy for how to actually hedge for that and how to avoid some of these risks. So that's just something that's important to realize, that we generally wouldn't invest in just a naked option seller unless they have a very good risk mitigation technique. So talking about the strategies that we did exit, there are 3 strategies that we exited this year. First, I'll start with the hedge S&P. Despite high expectations, we saw relatively early on that their quantitative model did not work in the first few months of 2022. And not only did that happen, they really had a large degree of strategy drift, where they took on a greater amount of risk than they were supposed to based on their mandate. We were able to see the performance daily. We did some comparisons, and over a few months, we lost confidence in their ability to deliver, given that they've moved away from the guidelines. So we decided to exit that in May. Ended up being a very good decision, as the strategy continued to deteriorate in the following months. Similarly, we had a strategy that arbitrage differentials and yield in DeFi. through a fund. We saw similar strategy drift there as well, just prior to the whole Terra Luna debacle. And we decided to exit that as well due to strategy drift, poor risk management as well. Then lastly, crypto lending. So to make this clear, we never invested in Terra Luna or anything like that. We always maintain actual lending with actual dollar-backed stable coins, primarily USDC. However, seeing what happened in Terra Luna, we decided we were very worried about centralized risk of counterparty because we didn't really know in the crypto space who is well collateralized and who isn't. And that really worried us, seeing how fragile that entire ecosystem was. So just as an abundance of caution, we exited all crypto exposure in May following Terra Luna. That ended up being a pretty good decision given what we've seen since. So those are exited strategies for 2022.
Great, thanks, Itay. And sorry, real quick before we go into the real estate update, I did just want to mention, it wasn't on the prior screen, but Itay and the rest of the asset management team, we are about to launch our third internal strategy soon. It's one we're really excited to introduce to everyone in more detail in the near future. And it's just an additional, very uncorrelated strategy that we're excited to add to the portfolio to, further improve the risk return profile of our overall portfolio. So be on the lookout for more info about that strategy sometime in the coming months. And then we can turn to the real estate. So those of you that invest in the real estate fund, I know you have been getting our updates. We're actually about to send another update soon with a little more detail. We continue to remain paused on new investments given the macroeconomic certainty, the high interest rates, just like Itay talked about how he doesn't want to go, buy a new house at 7% interest rates. We don't necessarily want to go buy new real estate properties at high interest rates either. And I would add that also similar to what Itay said earlier about homeowners, the asset price or the price of real estate has remained sticky despite the raising interest rates. And so typically we'd expect, prices to come down given the higher interest rates. While they've come down some, it certainly isn't enough to compensate for the higher debt interest rates. So we are paused on new investments, waiting for a better environment to deploy into. In terms of the two properties we do own, we have largely completed the deleasing process that we need to go through. As a reminder, this was removing non-paying tenants, allowing us to get into units that needed to be rehabbed in order to release them. We're now going through that business plan, that process, which is to rehab the units, make improvements, release them at higher rates, build up that occupancy level to stabilize both properties, make them more attractive for sale. That's going to include also some property level upgrades and CapEx spending to, again, make the properties, not just the units, better for both tenants and potential buyers. And so we're in the middle of executing that business plan. We've already turned over a number of units over the last few months, and we'll give everyone more detail on that plan in our upcoming real estate update. Itay, I'll turn it back to you to talk a little bit about our outlook for the portfolio in 23, and especially given some of those potential markets that you highlighted earlier, how we think we might do if those come to fruition.
Yeah, so what we try to do in this exercise is look at the expected return of each one of our managers, including our internal strategies, hedging, and how that all interplays into the portfolio under the different expected scenarios where, in a soft landing, we're expecting risk assets to perform very well. In a catastrophic landing, they would do very poorly, but bonds will do very well. And hard landing is really similar to this year where it's kind of a grind to the downside, not necessarily a crash mode. So looking at those potential returns, it's a little bit of a barbell where, funny enough, we're expected to do very well in both a catastrophic and a soft landing scenario. Some of it due to the convex nature of the hedging under a catastrophic scenario, where hedging is expected to perform exceptionally well. And the volatility strategy, for example, is expected to perform well because that would be more in line with, let's say, a COVID crash where they did very well over 100%. So total return to the portfolio is probably going to be closer to the mid-teens. under that assumption, and potentially as high as 20% under a soft landing scenario, given the bake-in upside. Now, a hard landing is probably going to be the most challenging, but we still believe we can return into 8 to 12%, just given the fact that some of our strategies have taken that widening, like we talked about with the bond strategy, in 2022. So there is built-in upside for 23, even in the event of this type of scenario.
Itay, can you just briefly touch on, just to give context, where we think the markets might go in each of these three, maybe using the S&P as an example?
Yeah, so soft landing scenario, we do have, we do have some examples like 21 or 2013 Q year. So, S&P may be up 30% under the soft landing scenario. Hard landing scenario, S&P is likely going to be down around 10%, as some of that damage has already been taken in 2022. Catastrophic scenario, S&P may be down around 30%. So those are the type of scenarios we're looking at in comparison.
Great. We'll turn it back to Tory.
Thanks so much, guys. So we're going to briefly touch on some company updates, and then we'll transition into Q&A. So we got a number of questions ahead of time, and so we thought we'd address those. We're really excited to share. We'll talk first about our financial standing, then talk about asset management, and then product roadmap. So number one, when it comes to our financial standing, many of you got the email, or you should have all gotten the email about announcing our Series A. We are thrilled to announce that Smash Capital led the round with participation from Montage Company, as well as many of you actually on the call today. We had a widespread participation from prior investors as well as many customers. So we are deeply, deeply grateful for that support. And with this funding, we are now well financed for the next, multiple years to come. So it puts us in a very strong position to execute against our business plan. And that leads to our next slide, which is about the asset management roadmap. So one of the big things that we are planning is an expansion of the strategies that are on the platform today, moving from the multi-strategy portfolios and special opportunities towards we're going to be also offering an Equi-only multi-strategy portfolio. So there will be a choice between, a hybrid model with internal and external strategies, as well as internal only. And then very exciting that we are going to be partnering to offer products in private equity, real estate, and potentially even private credit. And those will be offered at much lower minimums. So transitioning to the product roadmap and how these asset management products tie into the product roadmap. So one of the big things that we've heard from customers across the board, while we do have some, small family offices and ultra high net worth individuals for which the minimum was no problem, to reach a broader audience, we need to lower investment minimums. So one of the things we'll be doing next year is launching a version of our flagship multi-strategy with a lower minimum, as well as through partnership, launching some very innovative products that will provide lower minimum access to private equity, real estate, private credit, like I mentioned before. That's going to coincide with the launch of a mobile application, native, not just mobile web, as well as a rebrand that we're going to be rolling out across both web and app. We're very excited about that. And so you can look for that very early next year. We're also going to be streamlining the onboarding experience substantially. So thank you to all of you for your patience and your feedback as you went through version 1 of our onboarding experience. And we're really excited to share all that we have in store over the next few months. So with that, I want to transition into Q&A. Again, with questions about anything that you've seen today, you can obviously bring them up now, but also on the call today, we have Annie and Vince. Their emails are annie@equi.com and vincent@equi.com. So you can always reach out to them. You also have my email as well as Itay's. So please don't ever hesitate, to send us a note. So I want to quickly make sure we're going to pull up the questions that were submitted in advance. While I do that, please enter any questions you might have in the chat and we can answer those live. But I'll just address a few of these that we maybe didn't get to in the main presentation. So we, let's see, we talked about projected returns. Oh, this is a decent one, which is what are the projected returns of the Equi funds if markets move sideways for an extended period of time? Itay briefly, spoke about this and we talked about different scenarios, but if you extend, Itay, maybe the timeline, instead of looking at a 1 year, now I know this is impossible and we got to be very careful, like we can't give any guarantees of any kind. Roughly though, or directionally, how would the portfolio perform during, let's say, a lost decade? What would you expect? Would we be tracking to the return targets?
Yeah, I believe we will, as some of these internal strategies benefit from, more friendly. It's interesting, but the trading environment itself becomes more friendly as you get into these lost decade type of thing. So some of these absolute returns on these delta neutral strategies do very, very well. So we have a little bit more weight into those type of strategies. I believe that our low teen, mid-teen return target can be met under those circumstances, this is one of the reasons I'm so excited to be a customer, because it's one of the best hedges we have against a lost decade, right?
Absolutely. So I think I know the answer to this question, but you tell me, are there any plans to re-enter the crypto or DeFi space? And if so, what are you watching to drive that decision?
Not at this time. I think it's very, very early. I was first to pull the trigger when people didn't think there was no systemic risk. I was very hesitant and very early in basically getting out of the space. I think signs of stabilization would be required, and I think we're pretty far from that. It's still a pretty new space. I think on a regulatory basis, if U.S. regulatory bodies start regulating the space better, SEC, CFTC, etc., it would make the decision easier, because then you would be able to analyze the solvency risk of these counterparties.
Yeah, this is a great one. Actually, I think to clarify, so given that Equi is non-correlated with general markets, doesn't this mean the funds are uncorrelated once the market goes up? I know that is not what your backtoes show, but they want to understand why. It's a good question.
Yeah, so I think what's good to understand here is that correlation. So everything is correlated to something. First, let's start this way. And there's different environments in which these returns can manifest themselves in. So first off, when things are doing well and the economy is stable, correlation drops. So the 1 month return of the portfolio is going to not necessarily be the same as the stock market. However, the divergence in correlation allows this smooth and steady upside return. What we've noticed is during down cycles, correlations tend to pick up even in things that are supposedly not correlated, because there's just less liquidity in the world. So people will sell whatever they can sell to fund margin calls and other things in other places. So if you lay out a chart this year of, let's say, S&P 500, Bitcoin, US Treasuries, Euro USD, some of these other asset classes, you'll see it's all been one trade. So there's no benefit to diversification. In a way, which is why we had to enact the hedging program the way we did. So what we're trying to do is minimize correlation during these types of periods of time. So yes, it means that during an upcycle, we're not necessarily correlated one-to-one with the returns, but some of that upside convexity in risk assets helps us in some of our strategies to benefit on the upside as well. So it's a little bit of a weird answer. But really the non-correlation doesn't necessarily translate to low returns. It just means uncorrelated returns.
Yeah. And this is we'll come back to this in a second, but this is a brief question. What are some good alternatives to cash?
Yeah, so US Treasuries, short-dated Treasuries, have now been a very good alternative to cash, but that's fairly recently. Somebody had told me the other day, well, what if I was in Treasuries this whole year? And I would say, well, then you would have been down 25% because you came from a very low absolute base on the US Treasury. So now, for the first time, bonds have been a very good alternative to cash, which is again a new phenomena for 2022.
Yeah. So I'll get through the rest of these and we'll start answering some more that have come in through the chat and Q&A tool. Really excited about Equi's progress and would like to invest more funds with your team. Share more about the balance sheet. We did runway, future plans. Hopefully we address that. We're thankful for the opportunity. Okay, actually, it's not really a question. We addressed, balance sheet is very strong. We got actually a separate question in the chat, which can go towards this, which is there's a question about current AUM and forecast AUM. So we're really proud. We crossed the 100 million mark. We're at 103 approximately. So 103 million in assets under management. which is wild to think that 12 months ago, or 12 months and a week, let's say, we were at 0. So the growth has been very fast. But with the expansion of the asset management team, Itay, maybe just to give people a sense, with the current asset management team, I know we also we have a current role open for one additional hire. How much AUM do you feel comfortable that the team can scale to managing before you expand the team much further than that?
Yeah, so just to give you context, Noor alone, even though he had the support of some of his staff members, managed $1 billion for Leon Tech. So the current team and how we structure it with the current headcount that we're hiring should not have a problem scaling to about 1 billion AUM before we need more headcount.
Awesome. And so 2023 forecast AUM was the other question. Obviously, very difficult for us to say. We are in conversations with larger family offices who are potentially going to make much larger investments. There's a single investment could double our AUM, but realistically we're also taking lots of small checks. So we're really balancing the business between those two. As we shared, the mobile app that we're launching is really designed, and the lower minimum products are designed for more mainstream accredited investors. Although we will have products that are going to be exclusive to family offices and things of that nature. So hopefully that answers that question. And then, we also answered the question about a mobile app. And in terms of venture funds product, so it's a great question. We've explored venture. We do think that there's a couple interesting takes there, but usually our position, and definitely Itay and the asset management teams, is they don't ever want to offer a product that they wouldn't themselves invest in. So that means that the standard is very, very high, and they have a very particular investment philosophy that they maintain across our offerings. So unless we have an offering that fits in the product suite and meets their standards, we might not have it. Now, venture is a harder investment to offer and meet those standards. So we're in more of a wait and see, but it is obviously something that we're exploring. I see there was one other question. Oh, this is actually a good one, Itay. So why would Equi include strategies that are under the portfolio's return target? That's a great one.
Yeah, so the portfolio's return target is an average. So the way we think about it is about 70-ish% of the strategies in the portfolio are very slow and steady, lower returning type of strategies that gives us a very stable type of core that's not too volatile. But then that allows us to take about 30% and invest it in higher returning and higher potential type of strategies that could be a lot more volatile. But even if they do go through a period of volatility, because they are on a relative basis a smaller percentage, it doesn't impact the portfolio as well. So when you really do the math on that, it's a much better way to invest, to have a stable core and these kickers around it for the total stability of the portfolio, versus just having a collection of return targets that are all the same. That actually creates a much more volatile portfolio.
Makes sense. Comes back to the concept of diversification. What's the difference between correlation and beta? And is one a more telling statistic than the other? I think this is also very relevant to that earlier question of how do you capture upside if you're uncorrelated?
Yeah, beta is really the volatility of the portfolio, not necessarily the correlation of the portfolio. So if you have a high beta, that just means that you do the same thing as risk assets do, but you just do it more than the S&P. If the beta is very low, that means that the risk of the S&P is considered very, very low. So I've been actually proud of our ability to maintain both low correlation and low beta throughout 2022, despite this challenging environment.
Awesome. So anyone else, do you have questions? Want to make sure we get to everyone that might have one. Let's see. Feel free to drop it in the chat. If not, what we can also do, if there's no further questions, we can actually stop the recording, and we're happy to jump into a live chat and just catch up, because it's been a while since we've gotten to speak to many of you. So I can do that unless they're okay. This last questions, and then let's say I just saw one more come in, but last call for questions if you have them. Otherwise, we'll we'll transition into a catch up. So I saw one question, which was, oh, two questions. Okay. So when is the next Equi special opportunity? Great question. To clarify, the way we approach special opportunities, and Itay can speak towards this as well, is we really only, the asset management team will only deem something a special opportunity if they have strong enough conviction, as well as we think that it's fitting as a standalone investment. Many of the investments don't make sense or have minimums that are far too high to fit in the average person's portfolio. So in terms of when we will offer it, it's Itay, what would you say? I mean, it's anyone's guess, because it's more about the alignment of like the investment, the timing, everything needs to align properly, right?
Yeah, so it's really kind of a little bit of a market issue to just get the best conditions.
And then next one, how does Equi make sense of the recent B-REIT redemption halts and commercial real estate market in general? So maybe this will be, unless there's any more submitted, we can have this be the last question, and then we'll go ahead and turn off the recording and catch up with all of you. Any commentary on the B-REIT, Itay?
I can't comment on that during recorded session.
Yeah, it's another company's product, and we'll go ahead and we'll end the recording here, and we'll get 6 minutes to chat with you all. So thank you all for joining so much. We really appreciate your support. We appreciate having you on the platform, and we look forward to a big year to come.